Okay, folks, welcome back. All right, so this is price action model number 6, universal trading model, and we're going to be specifically dealing with the buy side low resistance liquidity runs and fractals. Okay, for the stage, we're going to be looking for a liquidity draw. The setup is going to be a buy side of a market maker profile, and the pattern is going to be fair value. Okay, so buy side low resistance liquidity runs with fractals. Okay, the buy side expansion. The market maker sell model, we're going to be focusing on that initially. So in the chart, and this can be in any time frame. Now before I get into it, just let me preface it by saying that the things I'm going to be discussing here are not new to you. Okay, so we're not redoing the mentorship. What I'm trying to do is convey the ideas, how I go into the charts personally, and arrive at the setups that you guys see me do on a weekly basis. So when we do our weekly commentary, I'm highlighting the levels at which I'm interested in, or maybe a directional bias I want to focus on primarily. But the key levels are really what I want you to be studying, and then also go back in hindsight and look at what we've seen in post price action, in other words, after those levels have been traded to. And not only does it pan out like we were anticipating relative to the commentary, or if it fails, but when it does pan out, what is it actually delivering in terms of price? Okay, and I think what you're going to see here is really the core of which model I trade mostly, okay, because I see when dealing with the mentorship and the things that I share publicly. So when you understand this, it allows you to be a universal trader. In other words, when I say universal, it doesn't mean you're day trading, scalping, and swing trading all at the same time. I guess that would be the highest order of doing it. But what I mean by universal is that you can find a setup, and I want to be very careful when I say this because I don't want you to feel that I'm inviting you to overtrade, okay, or force a setup. But if the setup is there, you should be able to identify it and highlight it in your price action. Okay, so let me restart this. So when the chart, again, this is any time frame, presents us a bullish condition for a market, we have to understand when the market is poised to move higher based on a draw on liquidity. Between the moment and price, we identify the liquidity the market will seek and the price level of the targeted liquidity. This is our range of opportunity. In this case, we have a level above us, okay, and this is obviously with the benefit of hindsight in our crude depiction of price action here, but we are going to assume that we have some inkling that the market's going to want to trade up to that level. Now that level, relative to whatever time frame you're looking at, could be a bearish order block, it could be a run above a previous high, it could be a liquidity void or fair value gap that needs to be filled in during a deeper retracement. Whatever that level is, or premium array, it's going to be up to you to frame out, okay, because obviously you could be a scalper, you could be a day trader, you could be a short-term trader, one shot, one kill, a swing trader, or a long-term position trader. All of those styles or methods of trading can be accomplished by this model. Okay, now when I say this model, it's assuming, again, like we do with most of the models so far, is I'm kind of giving you more of my personal opinions and slants on the approaches themselves. With that, I'm going to kind of give you what I do on a week-to-week basis, and then if I don't see my weekly analysis pan out, or I do see it pan out, what am I actually doing to work in a pattern or a setup? So with that assumption that we have a liquidity draw, okay, above us in the form of a premium array, it doesn't matter what time frame it is, okay, so kind of like suspend that that need to know that, okay, because I know you're probably saying, well, what time frame is this, Michael? Okay, it's any time frame, any time frame whatsoever. And I'll go into the charts and I'll show you some things with it, obviously, once we go through the theory of it. But the draw on liquidity is going to be above us, so we're anticipating a run up in price or building in of a premium, okay, and then the beginnings of the move may not be clear to you, okay, but hold that for right now. But the beginning of the move generally will be some measure of bullishness. Now, it could be the end of a existing bullish trend. It may be a consolidation that finally breaks out, or it could be an altogether reversal, okay? It's not apparent or needed to know that right now. We're just looking for a point at which the market's going to build in a premium or rally up, okay? That range of opportunity is seen here. So when we first identify the range at which the market should build in a premium or trade higher, in other words, in layman's terms, up to our predefined draw on liquidity, okay, to a premium array. You may not see that initial buy at the large green arrow, but after the initial move higher, your eyes should, based on all the examples you've seen in the mentorship and through your own study of price action, you should be able to see this as a potential buy. So buy point number one, that first retracement, it may or may not come back to an area of the original consolidation. If it is allowing that first retracement could be a retracement back into a fair value gap inside that first leg up, or it could be an order block that it trades down into. You have to use your PD array matrix, but that buy should be the one that you're able to see initially, even if you don't catch the initial beginnings of the upside move. And then obviously there's always the likelihood of a secondary retracement that allows for more buying or a buying entry that you have missed on the previous two instances, with an expectation that it runs up into that liquidity. If this were a daily chart, this could be the setup that takes place over 1 or 2 days. Okay, so these impulses from point number 1 up to the high between point number 1 and 2, that may be 1 or 2 days to transpire. And then we have a retracement of 1 day, and then the weekly expansion continues, and we get the high of the week as it reaches into that liquidity pool. If this were a daily chart from an intraday perspective, rather, in other words, say it's a 15-minute time frame, this could be an Asian range, false break lower, and the market rallies up again in New York and has a market reversal in the New York session or London close session, and then the day reverses and trades lower. If this were a weekly chart, okay, we could have a long-term consolidation that sees a impulse leg that moves higher, and the market trades for several weeks higher and retraces back down. That point number 1 would become an ideal scenario for long-term position entry or a swing trade. If you miss the 1 point and it starts to rally up, and again, this is a weekly chart, the retracement back to point 2, which would be a discount array, okay, relative to the range that would be created looking at the price action. Again, this is a very crude depiction. It's only a little line drawing I made in my computer just to communicate the idea or theory. But that point of number 2 could be, again, another area of which you could do a position trade or a swing trade. Now, it doesn't mean you can't take day trades at that same price point, because they'll overlap, obviously, when the price wants to move higher with magnitude and energy. either point 1 or 2 or the original move that begins that whole price leg up at that green arrow, either one of those 3 price points is a good buying opportunity in theory. I'm just being realistic in describing that you may not see the initial one, but that initial impulse leg, once that first retracement occurs, you should be really eyeballing it. Should be able to see it, at least after the mentorship. You should be able to see those types of setups. If this is a hourly chart, okay, say it's an hourly chart, and we had the impulse leg up and the retracement down to 0.1, that could be the London setup, okay, and then we see the expansion that goes up into the point or high between number 1 and number 2 low, and that retracement at point number 2 may be London close, where it sees a continuation further into the day and trades up into our liquidity pool. Okay, so the things that you've learned in the mentorship, they're applicable to this model, but you have to apply the things and characteristics that I taught for each respective model or style of trading throughout the mentorship. Now, when the chart offers this condition, the initial consolidation or base of the market maker sell model may not be easy to spot, as I mentioned earlier. However, after the initial impulse swing higher forms, it is generally going to be easier for you to locate the next draw on liquidity. In other words, you can see it after it starts. This is generally when you see like the optimal trade setting up. It's, oh, well, that's what it's trying to do. Let me see if it's going to reach up to that old high or bearish order block, and then you have it. It's generally how most of my students see the setups. They don't really always see the initial reversal or break from a consolidation. They always see that impulse leg, and they see the optimal trade entry. So if that's what you're finding yourself doing, that's okay. Don't feel that you have to have that initial impulse leg or anticipating that. It's not necessary. Okay, over years and years of experience, you'll start to build in anticipatory skills that will help you see that. But what I want to focus on is that you only need 0.1 or 2 in this model to be able to find the setups. Okay, and just finding on the specific time frame that you're looking at. What time frame is that? Whatever you're comfortable trading. You know, if you're a position trader or you want to do a really thorough top-down analysis, you're going to be working from a monthly, a weekly, daily 4-hour, 60-minute, 15-minute, 5-minute chart. And you're going to do these types of things and look through all of your time frames to find a potential setup. Now, by doing this, this will aid in determining the market maker sell model smart money reversal, okay, or the high here, and where each generic level of accumulation of longs will form. In other words, buying opportunities for us until the liquidity is absorbed at the high. Okay, the buy side expansion on the market maker buy model. Now, when the chart, again, any time frame presents us with a bullish condition for the market, again, we have to anticipate and understand when the market is poised to move higher based on a draw on liquidity. Between the moment and price, we identify the liquidity the market will seek and the price level of the targeted liquidity. This is our range of opportunity. In this case, we've seen a market in consolidation. It broke down. We didn't see any of that. It just caught us off guard, but we see it trade down to a logical level of support or to a discount array. The market shows a willingness to want to be bullish in this instance. At this price point here, we would anticipate a rally. From that point to the equal highs or original consolidation, this is our range of opportunity. Point number 1 is our initial point of buying interest. If we don't catch the smart money reversal, it's not necessary, it's not important. But point number 1 would be the area at which we would look to take our long entries. And if we miss that, or if we want to add to a winning position, we can use point number 2 with the anticipation that we're going to run the equal highs or the liquidity resting above the original consolidation, which is the market maker buy model. Much like I said earlier, when we were looking at the market maker sell model, with the buy model rather, again, it's the same premise that any time frame that we can see this forming, the main points that you have to have is a period of consolidation that leaves an area of equal highs. Okay, so if we have that, it could be equal highs, triple highs, or a consolidation range. Any time frame, if we see it break down and it trades to a very clear and obvious discount array, we anticipate this model unfolding. Now, I'm going to show you some things in price action that we just recently did in the last couple weeks with the Twitter feed and with the commentary. But it's important you know that, again, this is not limited to any one specific time frame. If you understand the elements of what has been taught in the mentorship and couple it with this model, it'll help you find and formulate a approach to trading any time frame. So if you are, well, I guess flexible to the degree that you're not limiting yourself to any one particular style, but you're comfortable and fluid with the understanding of price action, you can do a thorough top-down analysis. And if you get to a point in that top-down analysis that you see this type of formation, that's your beginnings of understanding what you should be working in, what style at the moment. Because obviously, any given moment, you can't be a long-term trader. Okay, let's just be fair about it. You can't be a swing trader at any given moment either. You know, there has to be a condition, an underlying premise in the marketplace to facilitate that style or approach of trading. Obviously, every single day, you can be a scalper to some degree. Doesn't mean you're going to be profitable, but you can find or justify a reason to do something every single day as a scalper. A day trader, the same thing. Not always the case like it is with scalping, but for a day trade capturing the daily range, just about every day it offers that. Obviously, you know that's Tuesday, Wednesday, and Thursday. And there is a degree of patience that's required if we're going to be a swing trader. Okay, so if we see this type of formation on, say, a daily chart, that would be a really good scenario to be a swing trader or a short-term trader trading at point number 1 or point number 2 with the expectation that we run those highs relative to the daily chart. If this is a weekly chart that's forming this pattern, we certainly could be a long-term position trader at point number 1 or 2, okay, and allowing the market to trade up to the equal highs relative to our market maker buy model. So let's go over to the charts, and I'll give you a couple of examples, and I'll give you the mindset that I approach the market with each week to help me find the setups that you see me share with you weekly and by way of Twitter. Okay, folks, we have the British pound versus the dollar index, rather long-term time frame weekly chart. Okay, obviously I have everything mapped out already. Let me take these dividers off so you guys can see a little bit cleaner. So we have a consolidation in here. Okay, we may not have seen this original consolidation until we saw this first impulse leg. Okay, so right away our mind should be thinking, well, this thing's probably going to be reaching higher. So what would it be reaching for? So if we scroll over to the left, you can see that we have the highest series of up-close candles is here, not this one, okay, because the bodies went higher on this one, and we're not trading supply and demand, so we do cut through candles. So we have our interest at the open on this at 143.46 or thereabouts, extending that out in time. We see the consolidation run, impulse leg, retrades back to it here. You pick up a buy there. We have a down close candle, and then we have a retracement into this price point here, which is the bullish order block. Price point number 1 here on a weekly chart. This would be a buying opportunity, reaching up into that premium array. Market trades back down. Not trying to pick the tops, not trying to find a long-term reversal, sticking with the idea. We see our market trade down again, run a low, looking for a potential opportunity to go long again, runs back up into and higher than the previous high. It ultimately does reverse, but this is the liquidity that we'd be aiming for, trading back up into the order block. Now we also have this long void in here. The market would have wanted to seek to fill that, and obviously we saw that transpire. But once the market does break down and we're on the other side, or the sell side of the curve on the models, once this low is broken, our model suggests that we're going to see a low come in the formation of a run below the original consolidation. So you can see a market maker sell model here on the weekly chart. You can see this as the reasons why we were looking for lower prices and ultimately a run below these equal lows in our weekly commentary for months throughout the bulk of this year, springtime to the present time of July 22nd, 2018. We can see that there's been a willingness to want to trade lower in cable. All right, we're going to drop into another time frame and give you a perspective on how this is useful as well. Okay, we have a cable chart here. This is an hourly chart. And I want you to take a look at it for a minute before I pull it out and start showing you the things that go through my mind and what you saw transpire through the commentary last week going into the reversal at 29.65. Again, these were tweeted on Twitter before the fact, so their reactions are not hindsight reflections. They're been shared with you beforehand, so that way we can participate in the active study. But looking at price, we've seen price trading lower, and we had a long-term daily bullish order block at 129.65. And you guys can go back through your charts and see that relative to the time of this recording and where that resides. But this is the bullish order block on the daily at 29.65. As it slams into that level, our eye goes to this right here, clean level. And this has actually been tweeted on my Twitter feed on the 19th. Okay, so we saw this entire drop down, and I posted a chart with a little question mark above here, trying to draw your attention to what do you think this is. Obviously, the first assumption is, well, it's clean highs, they're going to run that. But how many of you thought to include the aspects of a bullish ICT market maker buy model? Equal highs, well, that's a consolidation, right? Price drops down, leaves the consolidation. Smart money reversal, low risk buy right here. Trades right back down into the order block right there. So that's point number one. And we have another rally up, and price drops back down into what? Bullish order block. So this is point number two. You could use this as point number two, or this as point number two, trading into a rejection block here. You can see the effects of using the PD array matrix and your personal unique perspective, if you will, on price. We're all going to be looking at price slightly different regardless of what we trained our eye to look for. You're going to be more comfortable. Some of you would say, okay, well, I see the order block here, I see this big run up, but I want to see it trade down into the mean threshold here, right in here. Well, you may get this level, you may not get this level, you may miss it. Price starts to rally again. You have a rejection block noted here. The bodies are very close to one another, and they're close to one another over here, and also overlaps with the opening of the down close candle, which is a propulsion candle. Okay, so we have a propulsion candle, which is another bullish order block that feeds into a previous order block. So when you have that, you don't really want to see what? The mean threshold, according to the rules. So the market is most likely going to stay above the mean threshold in this regard, and you see that come to fruition here, right out of your notes in the mentorship. So if that's the case, we wouldn't anticipate a very deep retracement in this order block. We would look at the open or the high and get our fill based on that. And our stop would be below the propulsion candle or just below the mean threshold. Okay, so even in this little bit of a consolidation, with the expectation that the larger bounce at 129.65, which is likely, not promised to anyone, would see a run up into the equal highs here. Price expands up, runs the equal highs, take your profits. Leave a little bit on because you don't know how much juice you're going to get off of that 29.65 level. And train your eye to zoom out a little bit. I'm not going to do anything to the chart, but look at it again. Do you see it? Consolidation up here. The market drops down. Distribution, redistribution, another level of distribution, which was the model we just used for our market maker buy model or profile, and it clears that level. Now the market trades back down into this level here, not for classical support resistance ideas, but we're looking for the area over here at which we saw buying, and we saw buying in here. Okay, so I'm anticipating a willingness to want to see this rally again over time. How much time? I don't know. But I'd like to see it trade above here with weakness on the dollar. Okay, so that's how I internalize using the fractals, and I'm looking for low resistance liquidity runs by coupling that idea together. Okay, let's take a look at the dollar index. Now obviously we had the equal highs here, and we are looking for a run above that and a potential reversal to look for sells in the dollar index. Okay, if we go over to an hourly chart, okay, we can see those elements in this price action. 95.65 was the high seen here, but look at the equal highs in here. You see that? Let me zoom in. All right, so we have equal highs in here. We know what's going to be resting above that, buy stops. But look what's going on in here. We have a consolidation. Market rallies up. What is it reaching for? Not only is it reaching for the equal highs here, but it's reaching for that daily equal high. And we did our calculations based on model number 5, the standard deviations for intraday volatility. And it led us to 95.65 on this particular day. So we have the market maker sell model here, consolidation, runs up into a premium. Yes, it clears equal highs, but it's going to an area which on the daily chart would want to be swept, which was that 95.55 that was calibrated from 95.53, which is the old daily highs in here. Okay, remember we calibrated that in our amplified lessons for price action model number 5 that was shared with you just a few days ago. So by looking at that model here, we're seeing the price built in as a premium. Then we have a distribution, or smart money reversal rather, and then we have a low risk sell, and the price drops down, clearing out the equal lows, and that would complete one small fractal or ICT market maker sell model. Zoom out. We have it again. We have the consolidation in here. Market rallies away. Tries to come back into it. Rallies again. Area of accumulation. Area of accumulation. Smart money reversal. Distribution. Now watch what's going on. The price comes all the way down. Does what? Clears out this consolidation. Okay, so we have another market maker sell model that's completed right here. So now what do we have? We have the likelihood of the market wanting to get up into this range in here. Okay, we have this down close candle, and we have this area over here of old accumulation. So there's an area of which that would be interesting to me at 94.95 to 94.80 in that area, because we have a fair value gap in here, and that would create a balanced price range with this big drop down. So we had this open area, but in one single candle that was closed in. So I'd like 94.85 to 94.95. Okay, so if price can muster some strength to get up into that area, I would think that would be another area of distribution, and we could see some more selling on the dollar index. Okay, that's how I just apply it to you real time with this chart, so that way if it comes to fruition, you know why it did. If it doesn't, that's okay. We've had plenty of examples where it does pan out, but I did it with you live. If we look at the examples on price, even on smaller time frames, like if we look at a 15-minute time frame here, we can see that original consolidation on the dollar index, the equal highs, they run right up into that 95.65 level. And then distribution comes in after the market structure break, trades right back up into what? A logical premium array, which is this up close candle. And we have this little bit of a fair value gap in here. Trades up, heavy distribution comes in, and boom, clears out the equal highs, equal lows, and that draw on liquidity is gone. Okay, so if we have these understandings and we're looking at our specific time frames and we see the patterns, okay, go back through the mentorship and look at the classifications for the time frames. What style of trading does that equate to? And it helps you form the length of duration that you're holding for, and helps you stick to the mindset instead of going in and saying, I'm going to be a swing trader, and then getting shook out of the position because of something you saw intraday that would be a wonderful area to take position exits at on a scalp or a day trade, but you don't want to give up the entire position because you're trading off of a longer term setup that would be formed on a swing trade or a short-term trade basis. So hopefully you found this model insightful. It's not specific, and I'll build more on this when we go into the sell side for the second part of this. Until next time, I wish you good luck and good trading.